Good evening. We begin tonight with a historic market event. The price of gold has shattered all records, crossing the unprecedented mark of $4,000 per ounce. This spike immediately cast a shadow over recent gains on Wall Street, prompting a significant pause in the S&P 500 rally. This is more than a milestone. It is a critical indicator reflecting deep-seated investor concern and persistent fears over inflation and the U.S. economy's trajectory. Analysis: why gold is surging. Gold has long served as a safe haven asset, typically gaining value during times of economic instability or currency devaluation. The primary force driving this record surge is sustained concern over inflation. Large-scale government spending and expansive monetary policies are increasing the money supply, directly eroding the purchasing power of the U.S. dollar. Gold is being utilized as the classic hedge against this devaluation. Contributing factors include elevated geopolitical stress and ongoing speculation regarding the Federal Reserve's next move on interest rates. Lower rates typically weaken the dollar, making dollar-denominated commodities like gold more appealing globally. The market reaction. The 7-day rally on Wall Street, fueled largely by technology and AI stocks, cooled immediately following the gold spike. This correlation signals a rapid shift to a risk-off environment. Investors are observed rotating capital out of higher-risk growth assets, such as tech stocks leading the S&P 500, and into more defensive holdings, namely gold and long-term government bonds. For long-term investors, market analysts view this pause as a healthy, cautious reassessment of valuations following a period of rapid growth. Investment outlook. With the price of gold dominating headlines, many retail investors are asking if now is the moment to buy. The Dollar Facts advises against making reactive investment decisions based solely on record prices. Investors must understand their objective. Gold is a hedge designed to preserve wealth during turmoil, not a primary high-growth asset. Maintaining diversification is key. A small, disciplined allocation to gold, typically 5 to 10% of a total portfolio, is often sufficient for hedging purposes. Furthermore, the simplest method for most investors remains the use of gold exchange-traded funds, or ETFs, over the purchase of physical bullion. The record surge is not the cause, but a clear symptom of increasing market anxiety over the long-term stability of the dollar. The best strategy remains a disciplined, balanced portfolio constructed to withstand volatility regardless of the gold price trajectory.